In the summer of 2025, the geopolitical landscape shifted dramatically, sending shockwaves through capitals across the globe. Beijing imposed targeted sanctions on major European financial institutions, a move that stunned markets and policymakers alike. This was a direct response to Europe's increasingly close alignment with American economic pressure, signaling a new phase in global rivalry. China restricted access to its digital yuan market and sharply limited investment banking activities for European firms, sending a clear message: Beijing would no longer be the sole target of economic warfare but was ready to strike back. Europe's long-standing strategy of balancing U.S. security ties with deepening economic relations with China was suddenly and decisively shattered. The sanctions exposed the illusion of neutrality in great power competition, revealing that sitting on the fence was no longer an option. Beijing made it clear that economic interdependence comes with political strings attached, and that those strings could be pulled at any moment. The immediate impact was severe. Stock prices tumbled, risk models were upended, and uncertainty rippled through the financial sector. European policymakers faced the harsh reality that their prosperity was deeply entangled with a nation now in direct conflict with their primary security ally, the United States. The move signaled a fundamental change. Economic sanctions were no longer a Western monopoly, but a tool wielded by rising powers as well. China's retaliation marked the rise of new economic power centers, each wielding their own leverage and reshaping the rules of global finance. Europe found itself caught in the crossfire, pressured by both Washington and Beijing, forced to navigate a treacherous diplomatic landscape. The era of comfortable ambiguity was over, replaced by a new age of hard choices and visible fault lines. Now, Europe had to confront the true costs of its global entanglements, weighing economic interests against security commitments. The question was no longer if Europe would be forced to choose, but when and what the consequences of that choice would be. The wake-up call had arrived, and the stakes had never been higher. Europe stood at a crossroads, with its future hanging in the balance. Washington's pressure on Europe is relentless, a constant force shaping the continent's political and economic decisions behind closed doors. This pressure is deeply rooted in the defense of the US dollar's global dominance, which has been the backbone of American influence for decades. The dollar underpins American power, and any threat to its supremacy is treated as a matter of national security, prompting swift and decisive responses from Washington. The expanding BRICS bloc, now including more major economies like Saudi Arabia and others, is openly working to create alternative payment systems and even a new reserve currency. Their aim is clear: reduce dependence on the dollar, shield themselves from US sanctions, and carve out greater autonomy in global trade. The US quietly warns European banks and governments against supporting BRICS initiatives, reminding them of their security reliance on NATO and the Transatlantic Alliance. This puts Europe in a bind, torn between treaty obligations to the US and the economic opportunities of emerging markets, which are becoming increasingly attractive as Europe faces stagnation. Shunning BRICS at Washington's request would mean sacrificing much-needed growth at a time when Europe desperately needs new markets and investment. The unspoken American demand is total alignment in a global contest framed as democracy versus autocracy, a narrative that leaves little room for nuance or independent policy. Many Europeans, however, see it less as a moral struggle and more as a classic power rivalry, with Europe at risk of becoming a pawn in a much larger game. The US expects a clear division of the world and for Europe to fall in line, reinforcing old alliances even as the global order shifts. European leaders face a stark choice: commit fully to the American camp, risking economic damage and lost opportunities, or seek greater independence and risk US displeasure and possible isolation. The pressure to choose is mounting, with every diplomatic summit and economic downturn tightening the screws. Europe's room for maneuver is shrinking, as external pressures and internal divisions make consensus harder to achieve. The stakes are not just economic but existential. Europe's future role in the world hangs in the balance. The world is dividing, and Europe must soon decide where it stands, knowing that its choice will shape generations to come. US pressure isn't just diplomatic, it's economic, and its impact is being felt across the Atlantic. With tariffs and subsidies squeezing European industries, the landscape is rapidly changing. Tariffs on steel, aluminum, and other goods have made European exports less competitive in the American market, leading to significant challenges. The automotive sector, especially German car makers, faces a double threat: US tariffs and pressure to divest from China, creating a precarious situation. Generous U.S. subsidies for electric vehicles lure European companies to build factories in America, risking the hollowing out of Europe's industrial base and shifting jobs overseas. The tech sector is also hit hard, as U.S. export controls on semiconductors force European firms to cut off lucrative Chinese markets, impacting their bottom line. Complying with these controls means immediate revenue loss, and the long-term effects could be even more damaging. This accelerates China's push for technological self-sufficiency, potentially altering global tech dynamics. European companies are left reacting to Washington's policies, often without consultation, feeling sidelined in major decisions. Frustration is growing as Europe realizes its economic interests don't always align with America's, leading to public discontent. Leaders scramble to devise their own industrial policies, but they're playing catch-up in a rapidly evolving global market. The risk is deindustrialization as capital and innovation flow to more protectionist economies, leaving Europe vulnerable. Europe's economic model is under threat, and the stakes have never been higher. The transatlantic partnership is being tested as never before, with both sides needing to find common ground. Europe must adapt or risk decline as the global economic landscape continues to shift. The choices made now will shape its industrial future, determining the continent's role in the global economy. The pressure is relentless, and the clock is ticking, urging immediate action to secure a sustainable future. The Pirelli case reveals the risks of Europe's economic ties with China. In 2015, ChemChina became Pirelli's largest shareholder, symbolizing a golden era of Sino-European investment. But as tensions rose, Italy intervened to limit Chinese influence, using its Golden Power authority to protect Pirelli's autonomy. This shift reflects Europe's growing anxiety about Chinese ownership of strategic assets. Unwinding these deep connections is costly and fraught with diplomatic risk. The dilemma: protect national interests or maintain vital economic ties. The Pirelli saga is a microcosm of Europe's broader challenge. Europe is often forced into reactive, case-by-case decisions. The need for a unified, proactive strategy on Chinese investment has never been clearer. The EU-China economic relationship is vast and deeply intertwined. China is the EU's second-largest trading partner and a crucial market for European industry. Europe relies on China for essential goods, from electronics to critical raw materials for green technologies. This dependency creates vulnerabilities. Any disruption could cripple European industries. Beijing's leverage is real. Strong political stances risk economic retaliation. The EU's strategy is de-risking, not decoupling, diversifying supply chains and boosting domestic production. But reducing dependencies will take years. For now, Europe remains deeply entangled, balancing opportunity with strategic risk. Germany, Europe's economic engine, is now exposed. Its model, cheap Russian energy and exports to China, has collapsed. The war in Ukraine ended energy dependence on Russia, while US-China rivalry threatens German business in China. German automakers are caught between American pressure and the need to stay in the world's largest car market. Chinese EV makers are gaining ground both in China and Europe. Germany's economy has stagnated and pessimism is rising. The risks of overdependence on specific partners are now clear. Berlin must reinvent its economic strategy, finding new energy sources, markets, and innovation. The transition will be tough and costly. Germany's struggles are a warning for all of Europe. The continent must urgently address its vulnerabilities. Europe is searching for a third way: strategic autonomy. The goal: act independently, without over-reliance on the US or China. But the EU's 27 members have divergent interests, making unity difficult. Eastern states prioritize US security guarantees, others push for independent defense and economic policy. The EU is launching industrial policies to reduce risky dependencies, but faces tough competition from China, and the US strategic autonomy isn't about self-sufficiency, but credible options. Europe wants leverage to avoid binary choices between superpowers. Building defense and economic resilience is key. The balancing act is delicate, with little room for error. Europe's future depends on getting it right. Europe stands at a crossroads, caught between US security demands and China's economic power. The era of separating business from geopolitics is over. Aligning fully with Washington could mean economic decline. Defying the US risks security. The ultimate question: will Europe define and defend its own interests, or remain a pawn in a superpower rivalry? The choice will determine whether Europe is a global actor or a casualty in the US-China struggle. The continent's future hangs in the balance. The time to choose is now.